Adam Abbas joining us from Harris Associates, Harris Oakmark previously. You manage two funds. One's over $4 billion, and you're a Chicago native. It's great to have you here, Adam.
You know, I came over to Chicago at 18 years old, went to Northwestern University, and I've been here ever since. Got to go to University of Chicago for my MBA. Worked for great institutions like Lehman Brothers Asset Management, New River Bourbon, right down the road, 190 South.
Love that. That was a Easter egg slip in there.
That's right.
You got any gear left over from that? A
I
coffee
do.
cup,
I do. I didn't put on eBay. Went over to Richard Driehaus' outfit, got to help with the fixed income efforts there. And then most recently found myself at Harris Oakmark, where we're really pushing into fixed income dedicated space. And we just launched the Oakmark Bond Fund 5 years ago. It's going really well.
That's OakCX.
OakCX.
I referenced OakBX, which is the Equity and Income Fund. Before that, what was the business like in terms of the education at Northwestern versus Chicago? Did it feel like you entered a different ballpark at University of Chicago, or was Northwestern a beast too?
It's a great question. I mean, it was a beast, but for different reasons. I was actually an engineering undergrad, so I learned a lot of the technicals around critical analysis.
What kind of engineering?
Industrial engineering.
Okay, all right. I didn't see that when I did the research.
So the groundwork was there. We were doing a lot of the math, the critical thinking, but really the extension into the finance world and learning a lot of the details around understanding accounting and the nuance around how to think about financial evaluations. I really learned at getting my University of Chicago degree, so it's been great. Still
the top of the class in your mind, University of Chicago comparatively?
No doubt, right? No doubt. I'm biased, but no doubt. Northwestern undergrad, U of C, MBA, best there is.
All right. Well, let's talk some efficient market in the fund. Let's start with equity and income first, because I feel like there's a lot that we talk about that's increasingly blending that line. Equity products that are generating income. If it's ETFs using options to pull in heaps of income off these high flying companies, or when you look at bonds, how do you blend that? Where do you find the happy middle ground?
Well, I think the 60-40 space was kind of left for dead after 2022. We saw loss of principal on a mark-to-market basis with fixed income. People weren't used to seeing a 10, 15% drawdown on the 40% portion. And a lot of people have given up. They've rotated into gold, alternatives, et cetera. We think it's a really great time to be in the 60-40 space. That 40% fixed income, high quality balance sheets, high visible free cash flow. You can produce about 5.5% yields without taking a lot of credit risk. We want to think about corporate balance sheets. We want to be with management teams that are really taking a prudent approach to balance sheet management and in capital allocation. But I think that 60-40 in this new era where you can collect 5.5%, and that fixed income portion can be a ballast once again. I think it's a really good place to be, and don't give up on it.
A lot of the hate on the 60-40, essentially.
Yep.
I asked something similar to Sean Dranfield at PTAM yesterday, and his response was kind of, look, I just want to have an interest rate agnostic bond product.
Duration neutral.
Yep. Duration neutral. Is that a way through it, or is there, because it seems like your approach is security selection.
It is.
And I think that's what's interesting in your background too, because I've heard you on podcasts. I mean, you know the ins and outs of a lot of specific companies, almost the way that I hear traders talk about it from an equity side.
Yeah, no doubt. Harris Oakmark, that's really the core of the DNA, is we want to spend our time producing attribution for our clients through understanding the balance sheets, the cash flow statements, income statements, the management teams. We want to understand how capital allocation looks, what type of return on investment they're getting, and how that translates to ultimate intrinsic value, and then how that translates to ultimate default risk. And at the end of the day, we want to provide our attribution through that credit selection and not through making, we live in a tweet by tweet world.
Right.
We live in this.
People like that though. These guys like that.
They like it, and it can be good, it can be bad. Like transparency all the time, everywhere, we think is kind of to our advantage when we take a step back. We're disciplined 3 to 5, 7 year horizon. And we look when the market's all pushing one way, maybe it's a momentum factor, maybe it's a tweet, maybe it's an intraday move. We're looking back and say, what does this ultimately mean for fundamentals?
You're in there on short term, buying credit,
It's all a fundamental approach. We want to think about intrinsic value, our long-term horizon, and what does that mean for expected return.
Will it skew towards a value profile if you're doing it the bottoms up way?
It absolutely does.
Okay.
And on the stock side, we do about a 30% discount to intrinsic value. On the bond side, it's a spread approach, so about 30% to spread. So if you have 100 over credit, we're trying to look for something that trades at 130 and trying to get that spread compression.
Okay.
So it's always value discipline. We think that degree of safety actually is a kind of a risk mitigant that's provided to our clients.
Right now, the breakdown of bonds versus stocks in your fund, I think I saw it was at least 2/3 stocks.
Yeah,
is that right?
It's 60-40. We actually like fixed income here. At its peak, we were right around 68%, 32% for stocks versus fixed income.
Okay.
I think recently fixed income has become more compelling as valuations have risen on the stock side, and all-in yield has stayed elevated above 5%. I think real yields you can get 2.5%, depending on your view of inflation.
Right.
I think that's really attractive. Just high quality compounding at 2.5% makes a lot of sense to us here.
Who do you find wants it the most? Who's in the, because it seems like there's almost kind of an in-between where, like, you want the income, you want to have, you don't want to take equity-specific risk to that extent, but you also don't want to be creeping along if everything's going to be up and away as it has been. Is there an opportunity cost to being deeper into stocks if you're playing a fixed income?
Well, again, where our approach is long-term horizon and just really value oriented. So really it comes down to price for us.
Okay.
We think the prices afforded to us in fixed income are relatively cheap here.
Okay.
And as we look over 3 to 5 years, again, if we can compound at 2.5% real returns, that's a pretty attractive proposition, especially with where multiples in some of these growthier, more momentum trades in the equity side are trading today. So we think it's a pretty good trade-off, and it's a good spot to be.
Anything that you think in particular, security-wise, sector-wise, how specific? You got something hot for us?
Well, we don't do hot, but I think in general,
Where do you think it's undervalued? Where do you think it's
not
a
staying
deal?
away from the benchmark where all the flows are going to in the fixed income space, the big benchmark names. We like moving in kind of the more esoteric space and securitized credit.
Okay.
Looking at places that just a little bit less traffic where all the flow isn't going to. I think there's still opportunity if you look hard enough in those spaces to pick up some spread, pick up some yield, and total return opportunity.
Tell me about securitized credit. Do you like private stuff? Is that working into that direction?
We're staying mostly public in what we do, but we still pick up, on a relative basis, we're still in the 80th, 90th percentile we can pick up versus public corporate credit spreads. We think that's pretty attractive, especially in the higher quality portions of those stacks.
I think a lot of the stuff we talked about there for bonds applies to OC, right?
It absolutely does.